Walk past a self-storage facility and it doesn't look like much of a business. There are rows of metal doors, a security gate, a keypad, maybe a tiny office, no restaurant kitchen, no expensive inventory, no huge staff, no customers walking around shopping for products. And yet, across the United States, self-storage has grown into a massive real estate business with more than 2.2 billion square feet of storage space. The average advertised rent for a standard 10 by 10 non-climate controlled unit is about $120 a month as of July 2026. Storage cafe. So here's the strange part. How can renting out a few hundred empty rooms generate enough money to justify millions of dollars of real estate? And why would investors choose to own tiny metal boxes instead of something that looks much more valuable? The answer has surprisingly little to do with the boxes. It has everything to do with real estate, pricing power, operating costs, and the value of recurring cash flow. Imagine you own a facility with 500 units. A customer doesn't buy anything from you. They don't even really want to use your product. They just want somewhere else to put their stuff. And that simple relationship creates one of the most interesting business models in real estate. Let's follow the money. At its core, self-storage is incredibly simple. A customer rents a defined amount of space, usually month to month, and pays the owner every month for the right to access that space. The business doesn't have to manufacture anything. It doesn't have to restock shelves. It doesn't have to prepare meals. And once the facility is built and operating, the same physical space can be rented again and again. That's the first important economic advantage. The product is basically space, and space doesn't get consumed when someone rents it. If you rent a 10 by 10 unit for $120 this month, the unit is still there next month. So the business is essentially taking a physical asset and turning it into a recurring subscription. That's why the basic money flow looks like this. Customer pays rent, the facility collects revenue, the owner pays operating expenses. Whatever remains becomes property-level operating profit, commonly called net operating income, or NOI. And then, that NOI can be used to pay debt, distribute cash, reinvest in the property, or simply increase the value of the asset. But before the owner gets any of that money, there is a much bigger question. How much does it cost to create the storage space in the first place? That's where the economics get interesting. A new facility needs land. Then you have construction, site preparation, driveways, drainage, fencing, lighting, security systems, doors, climate control systems where applicable, office space, permits, professional fees, financing costs, and working capital. And land can be the biggest variable of all. A facility built in a dense, expensive metropolitan area may have completely different economics from one built on inexpensive land outside a smaller city. So there isn't one universal number for what it costs to build a storage facility. And that's important because a self-storage business isn't simply a buy some metal buildings and collect rent operation. The real investment is usually the real estate underneath the business. That's also why an existing facility can be so valuable. You're not just buying 500 doors. You're buying land, improvements, existing customers, historical occupancy, operating systems, and most importantly, a stream of future cash flows. Now let's build a simple example. This is an illustration, not an industry average. Suppose a facility has 500 units. Let's assume the average realized rent across all occupied units is $130 per month. If every unit were occupied, that would produce $500 to $130 equals $65,000 a month, or $780,000 a year. But no facility stays perfectly full forever. Customers move out, new customers move in. Some units sit vacant, so let's assume the facility operates at 90% occupancy. Now we're down to approximately $702,000 in annual rental revenue. And this is where one of the most important numbers in self-storage appears. Occupancy. A storage facility can have hundreds of units, but empty units produce nothing. 50 of those 500 units are sitting empty. That's 10% of the inventory generating zero rent. But here's what makes storage particularly interesting. The owner doesn't necessarily need a huge increase in customers to increase revenue. They can change prices, they can introduce different unit sizes, they can charge more for climate-controlled space, they can offer premium units, they can adjust promotions, And they can increase rates for existing customers over time, subject to market conditions, contracts, and contracts and applicable laws. That gives the owner another lever besides simply finding more customers. Price. And price is incredibly powerful in a business where the physical product doesn't change very much. Suppose you have a 10 by 10 unit. The building doesn't need to be rebuilt because the rent rises from 120 to 130. The customer still uses the same 4 walls. There is no additional inventory, no extra manufacturing, no additional product shipment. That's why even relatively small pricing changes can have a meaningful impact on the economics. But there is another layer. The customer isn't only paying for square footage, they're paying for convenience. They're paying because they don't have enough room at home. Maybe they're moving, maybe they're downsizing, maybe they're renovating, maybe they inherited belongings, maybe they run a small business, maybe they simply have too much stuff, and that creates something unusual about the demand. People often rent storage because they have a problem they want solved immediately. They don't wake up thinking, I'd love to spend $120 today. They wake up thinking, where am I going to put all this stuff? That urgency matters, because the business is selling something that solves a space problem, not something that people necessarily want for entertainment. And once the customer has moved hundreds of pounds of belongings into a unit, switching facilities isn't always completely frictionless. That's another part of the economics. Now let's talk about the expenses, because this is where people make a common mistake. They see $702,000 in annual rent and think the owner is making $702,000. They're not. The facility has property taxes, insurance, utilities, repairs, maintenance, security, marketing, management, technology, gate systems, payment processing, cleaning, landscaping, and potentially payroll or third-party management fees. Then there are major capital expenditures. A roof eventually needs work. Security equipment gets replaced. Pavement deteriorates. Doors break. Climate control equipment requires maintenance. The facility may need upgrades to remain competitive. So revenue is only the beginning of the story. And this is exactly why the self-storage industry is so interesting to investors. A mature facility can have a very high operating margin because many costs don't increase proportionally with every additional rented unit. Public Storage, one of the industry's largest operators, reported a 78.4% same-store net operating income margin for 2025. In other words, on its stabilized same-store properties, property-level NOI represented roughly 4/5 of revenue before expenses below NOI, such as interest and other items. Public storage. That doesn't mean every storage facility earns a 78% margin. A small independent facility can have completely different economics, but it illustrates the basic concept. Once the facility is built, adding another occupied unit doesn't require building another entire business. The infrastructure already exists, and that creates operating leverage. Let's go back to our hypothetical facility. We had about $702,000 of annual rent. Now suppose ancillary income adds another 3% or so. That could include things like tenant insurance-related income, merchandise, administrative fees, truck rentals, locks, or other services depending on the operator and market. For our illustration, that's roughly another $21,000. Total revenue becomes about $723,000. Now let's assume operating expenses consume approximately 22% of revenue. Again, this is an illustration rather than an industry-wide assumption. That gives us roughly $159,000 in operating expenses. What's left? About $564,000 of NOI. That number is much more important to a real estate investor than the original $723,000 revenue number, because NOI tells you what the property itself is producing before financing. And now we reach the part that explains why self-storage can become a very different investment from simply owning a rental property. Imagine, purely for illustration, that this stabilized facility cost $6.5 million to acquire. $564,000 NOI on a $6.5 million purchase price represents an approximate 8.7% capitalization rate. That's not a universal self-storage cap rate. It's simply what our hypothetical numbers produce. But the principle is what matters. The value of the property is closely connected to the amount of recurring operating income it can generate. If you can increase the NOI without proportionally increasing expenses, you can potentially increase the value of the entire property. And that is the hidden economic engine. Let's say the owner finds a way to increase annual NOI by $100,000. The building didn't necessarily become physically larger. There may be no new floor, no new wing, no dramatic renovation. But if the market capitalizes that additional income at an 8% cap rate, that additional $100,000 of NOI could correspond to roughly $1.225 million of property value. That's why sophisticated storage operators obsess over small changes in revenue and expenses. A few dollars more per unit, a few percentage points more occupancy, better tenant retention, lower marketing costs, more efficient management. Those changes can have an outsized effect on the value of the asset. But there's a catch. The facility doesn't automatically make money just because it exists. You still have to fill it. And filling a new facility can take time. Imagine building 500 units and opening the doors with only 20% occupied. You have nearly the entire expense structure of a real estate operation, but a fraction of the revenue. That period is sometimes called the lease-up phase, and it can be financially painful. This is where financing becomes dangerous. Suppose our hypothetical owner borrows 65% of that $6.5 million purchase price. That's about $4.225 million of debt. If the loan carried a hypothetical 6.5% interest rate and was amortized over 25 years, the annual debt service would be roughly $342,000. That changes the picture dramatically. The property produces about $564,000 in NOI. But the owner now has to send roughly $342,000 toward the mortgage each year. That leaves around $222,000 before taxes, major capital expenditures, and other ownership-level costs. The same property that looked like a $500,000 profit machine suddenly looks much less spectacular. And this is why debt can be both the accelerator and the trap. Leverage allows an investor to control a $6.5 million asset with far less equity. But the loan payment doesn't care whether occupancy is 90% or 70%. The bank still expects its payment, and that brings us to the number that really matters. Break even. If revenue falls, how far can it fall before the owner stops generating positive cash flow after debt service? Let's run 3 simplified scenarios. In a bad year, suppose occupancy falls to 75%, and the average realized rent falls to $115 because the owner has to discount more aggressively. Rental revenue would fall to roughly $518,000. Add a little ancillary income and you're around $533,000. If operating expenses consume 22%, NOI falls to roughly $416,000. After our hypothetical $342,000 annual debt service, only about $74,000 remains before taxes and major capital expenditures, still positive. But the cushion has become much smaller. Now consider a normal year. Our 90% occupancy and $130 average rent produce roughly $564,000 of NOI. After debt service, approximately $222,000 remains. Now imagine a great year. Occupancy reaches 95%. Average realized rent climbs to $145. Rental revenue jumps to roughly $827,000. With ancillary revenue, total revenue could approach $851,000. At the same illustrative 22% operating expense ratio, NOI approaches $664,000. After debt service, the owner could have around $322,000 before taxes and major capital expenditures. Same buildings, same basic product, same 500 units. But the economics have changed dramatically because occupancy and pricing changed. And that is the real game. Self-storage is not really about renting boxes. It's about maximizing the revenue produced by every square foot of a relatively fixed real estate asset. Now here's something even more interesting. The industry isn't operating in a vacuum. New supply matters. According to Storage Cafe's July 2026 industry data, approximately 57.7 million square feet of self-storage space was delivered in 2025, while about 52.9 million square feet is expected to be delivered in 2026. Storage Cafe. More supply can be good for customers. More choices, better facilities, competitive prices. But for owners, too much new supply can create a problem. Imagine you own a facility that's 90% occupied. Then a brand new facility opens 2 miles away. It has shiny hallways, better lighting, modern security, climate-controlled units, and an introductory promotion that undercuts your prices. Suddenly, your customer doesn't just have a storage problem, they have choices. And that can pressure both occupancy and pricing. This is why location is so important. Not simply because the land is valuable, but because storage demand is highly local. A facility can be successful in one neighborhood and struggle a few miles away. Population density matters, household formation matters, moving activity matters, income matters, housing sizes matter, competition matters, and zoning matters. You can't simply decide that an empty piece of land should become a storage facility and expect the economics to work. The land has to be legally usable, the market has to need storage, and the revenue potential has to justify the cost of the real estate. There is another reason the business can be attractive. Self-storage can be relatively labor-light. A traditional retail business may require employees on the floor all day. A restaurant requires cooks, servers, managers, cleaners, and constant operational coordination. A storage facility can increasingly use technology for access control, online rentals, automated payments, cameras, and remote management. That doesn't eliminate operating costs, but it can reduce the amount of labor required to operate each dollar of revenue. And when you combine recurring monthly payments with relatively low labor intensity, the economics can become powerful. But there's one more source of money that many people overlook: the asset itself. An owner isn't necessarily making money only from monthly cash flow. If the property produces more NOI, the property can potentially become more valuable. If the owner improves operations, raises effective rents, increases occupancy, or adds rentable space, the income stream can grow. And if the market continues to value that income stream, the asset value can rise. That's where self-storage becomes a wealth-building strategy rather than simply a small business. You are operating a business, but you're also controlling a piece of real estate. And you're potentially using debt to control more real estate than you could buy with cash alone. That's the combination investors are really buying. Recurring revenue, operating leverage, real estate, and leverage. But that combination can work in reverse. If interest rates rise, financing becomes more expensive. If occupancy falls, revenue falls. If new competitors flood the market, pricing power weakens. If property taxes rise, expenses increase. If insurance becomes dramatically more expensive, the property's cash flow can deteriorate. And if the owner borrowed too aggressively, the debt can turn a temporary slowdown into a serious financial problem. This is the part people miss when they say self-storage is a passive income business. It can become highly automated, but the investment itself is not automatically passive. Someone still has to choose the location. Someone has to underwrite the property. Someone has to set prices. Someone has to manage customer acquisition. Someone has to monitor competitors. Someone has to maintain the property. And someone has to make sure the debt doesn't overwhelm the cash flow. The biggest misconception is that the business makes money because people have lots of stuff. That's only part of it. The deeper reason is that the owner controls a scarce, rentable piece of real estate and repeatedly monetizes that space. And the economics become especially attractive when the owner can increase the income without having to increase the physical footprint by the same amount. That's the hidden leverage. A 5% increase in rent doesn't mean a 5% increase in construction costs. A 5% improvement in occupancy doesn't mean building another facility. A reduction in labor or marketing costs can flow directly toward NOI. And because real estate investors value properties based heavily on income, improvements in NOI can potentially have a multiplier effect on asset value. So, is self-storage actually a good business? It can be, but the answer depends on what you're buying and how you're financing it. A great location with strong demand, disciplined pricing, manageable debt, and efficient operations can produce attractive economics. A poorly located facility with aggressive competition, expensive financing, and weak occupancy can become a very expensive collection of empty rooms. And that is the bigger lesson. The business doesn't look exciting. That's exactly why it's easy to underestimate. From the outside, you're looking at concrete, asphalt, metal doors, and a security gate. But underneath those doors is a financial machine. Customers create recurring revenue. The facility turns that revenue into NOI. NOI supports debt payments and owner cash flow, and growing NOI can potentially increase the value of the underlying real estate. That is the real business, not the boxes, not the locks, not even the storage units themselves. The real business is turning a fixed piece of land into a predictable stream of cash flow, and then finding ways to make that cash flow worth more. If you enjoy breaking down the hidden economics behind ordinary businesses, subscribe to Money Behind. Because sometimes the most interesting money isn't hiding inside the businesses that look exciting. It's hiding behind the doors nobody thinks twice about. And that's the question I'd leave you with. If you had several $1 million to invest, would you rather own a flashy business everyone talks about, or a boring row of storage units quietly collecting rent every month? Because once you understand the money underneath the business, boring can start to look very different.